And joining me on the podcast right now, and of course, live on video. I say live, he's always live. He's always lively. It's Paul Hill, full-time investor, equity analyst. You're right, fella. It's been a week, isn't it? God, it's been busy.
Two. It's been 2 weeks since we chatted, and I knew this final week in September was going to be a monster 5 days, and it hasn't disappointed at all.
Yeah, I've been, like I say, interviewing for results and stuff. It's been back to back. It's been some good, some bad, some downright ugly. But and it's a hard market at the moment. It's a very tough market. It's not very forgiving. I've seen companies release okay news and taking a big hit. I think it wasn't that bad.
No, you're exactly right. I mean, I think what's happening is that there's definitely sort of like a level of skepticism at the moment with investors, and anybody slightly disappointing is getting totally whacked, really out of proportion to what it was. And there's sort of like the epicenter of it seems to be those stocks which were considered or perceived to be COVID beneficiaries, and also anything in the consumer space that sort of potentially has a bit of a bump in the road. And unfortunately for Boohoo, which is one of my investments, as you know, they are both in that sort of like that Venn diagram and right in the center of it, i.e. COVID beneficiary and consumer focused. And to be frank, yesterday the shares fell 15% on really just extra cost news. They had higher costs, which is all largely to do with a pandemic. And also their revenues had slowed up from quarter one into quarter two. And all that was to do was largely with the Delta and supply chain problems and all this sort of stuff. And when you read between the lines, it's frankly the CEO, John Little, is doing all the right things. His strategy is perfect. I mean, you look back on what Jeff Bezos did at Amazon, yeah? And he basically took a long-term view, built his business up, and now it's a $1.6 trillion behemoth, yeah? Now, John Little isn't, I mean, obviously, Boohoo's not quite on the same level of scale, but he's taking a longer term view as well. So what he's done, he's investing in his infrastructure, in warehousing, in expanding it, automation. He's keeping he's making sure he keeps the top line motoring, investing in his brands and also the ones he's done selectively, bought over the last 6 months. So he's doing exactly what the strategy, says. And the shares got absolutely hammered yesterday. And I, as a long-term investor, are actually, when you look at it on a competitive positioning against rivals, particularly bricks and mortar chains who are frankly well out of this space and can't catch up, then you look at it and you say, well, actually, they're increasing their lead against their biggest competitors. And on that basis, the intrinsic worth of the group, in my view, went up yesterday, even though the shares fell 15%. I mean, it's just frankly nuts. And that's largely because of sentiment, as you say.
Yeah, did you see? I had what's called Dan Lane. He's an analyst at Free Trade, and he bought some yesterday. And he said this is the ideal opportunity for private investors, in my mind. If you got a bit of a longer term view, he said, I've dipped my toe in here. I expect a bit of volatility, over the months, but this is a good business. Like I said, record first half sales that shows the demand there. And like you said, they are a market leader, and you get this times like this are opportunities. He did mention, it's a reason why maybe the institutions standing on the side is the ESG issue, which is being dealt with, but until that's completely 100% and beyond that, sorted out, they won't touch it. But then he said that's an opportunity for private investors, though, because it's being sorted, so it's fine. So that kind of dip on a big stock like that is sometimes a gift, and
I mean, it looks it. Yeah. I mean, if you actually look at the run rate, I mean, let's be clear about it. It's best to, because you had this pandemic, which is 1 in 100 years, but you look at it bigger picture over a 2-year basis, and the business has actually gone up. The sales has increased 73%. Over a 2-year view, and they've doubled their market share in the UK and US. So when you take out the pandemic, that is an incredible achievement. And if you look against really stretching comparatives from last year because of the COVID, they did like for like, or they did growth of I think it was 34% in Q1. It went down to 10% in Q2, which was largely because they had really stretching comparatives, if you think about it, against essentially between April and May sort of April, May last year was really just like for anything online. So they went down to 10% growth. But frankly, 10% growth is not bad. It's to be sniffed at, double-digit growth. And then when you pick through the details and look at their full-year guidance, then they're looking at healthy top-line growth of 20 to 30%. And their margins are going to be increasing by another sort of 0.5% or 1%. And that's obviously, the EBITDA margins. And that's still got a lot of the supply chain extra cost in there. But they're all doing exactly the right thing. And as you say, it looks like a total gift. And I've said this so many times, and that if I had some more money, I'd be buying more of it. And I think he's doing exactly the right thing. Intrinsic worth of that business has increased. And just give you an indication. I mean, I'm not, I like my numbers, and so you compare it to sort of like the share price of £2.10. Yeah, if you just use a market multiple of 20, you cast your mind to 5 years in the future, and they get to 5 billion of turnover. They're currently on a run rate of about 2.1, but if you do a 19% compound average, you get to 5 bill. And then you look at sort of the EBITDA margins of 10.5%, and that's what they did. If you strip out the pandemic extra cost they incurred in quarter one, in the first half, then you get a share price of £8.25. And even if you did a 15 times multiple, which has been less, 20% less, 25% less than the market, you get £6.20. And a 10 times multiple in 5 years, you still get £4.10, and that'd be doubling your money almost. So you just look at it. Is this a gift? Well, it looks like Christmas come early to me.
Yeah, and they'll be busy at Christmas as well. I know it's like the market's like that. People see dipping down. Funny thing, it was the most followed company on Vox yesterday. So I know private investors are taking the opportunity. So
I had lots of people asking me about what I thought on it. And another one, which is, let's just keep into that consumer space. Even if you produce good results in line with expectations. Revolution Beauty came out with a trading update about 10 days ago or something like that. Yeah. Adam Minto, the founder and CEO, their growth over the first half was up 35%. They're bang in line with expectations and expect a big second half, because it's obviously you've got reopening, you've got partying, you've got the Christmas, you've got Black Monday. You've got all of that sort of go back to the office and more socializing. So people obviously are, putting a bit more makeup on and doing their hair and this sort of stuff. And he, again, he's knocking the ball out of the park. He's extending his relationships in store with the likes of with Boots, and it's going really successful in the States with Target, because they're now the biggest selling cosmetics brand in Target in the US, which is just like, wow! Is this,
wow. That is big, yeah.
Exactly, it's absolutely fabulous. And now the shares have gone down, and that's because they're considered into this consumer space they say, it's discretionary. And now, what the market's missing is that the majority of the population is still cashed up, has still got a lot of savings that they desperately want to spend and go out and enjoy themselves, and because they've been locked down for 12, 18 months. And they're going to do that over Christmas, and they're going to be one of the, Revolution Beauty is going to be one of the, the beneficiaries. And again, if you just look at the numbers, I think the shares now are sort of like, last time I looked, they're about £1.50, which is again,
146.
Yeah, exactly. But if you look at their sort of like their run rate, I think they can easily double that turnover from about a £200 million, revenue to 400 million over the next 5 years. I don't think there's any doubt about that. And on that basis, I get a share price, and you use a sort of like a, your standard margin. I can see the shares easily, doubling from there. But if you use, Adam's expectations, and he's expecting to get to about £1 billion, you get a share price of over £12 over the next 5 years. And I don't think that's unreasonable. Yeah. That's not unreasonable, because he's got a few of the big cosmetics companies in his crosshairs. And again, it looks like a gift. The market has got this sentiment shift that it actually, even somebody putting out some good results gets whacked. So Just one of those
No,
things.
but that is the market. Like I said, sometimes with the benefit of a longer term view, you could look back in maybe a year's time and said, yeah, I picked up those two stocks there, and it's just at the time. And it happens a lot. I mean, if you, I don't know if you, I know one of your or two of your stocks took a bit of a knock this week, Rossyln, and also one of my stocks, Trufin, took a bit of a knock as well.
Did it? And Trufin? Why did Trufin get a bashing?
Yeah, it dipped about 20. Well, it's very illiquid stock, of course. Trufin is like a holding company. It's four companies. Three of them are fintech. One is a sort of gaming company. But the revenue went up sort of 18% to 4.9 million. PlayStack revenue, which is the gaming side, up 79%, 2.2. So it's all good, but they are going through a bit of cash. They did about 5.5 million of cash. Those four companies have 150 members, and they are investing in it because they've got things going on, with like I said, Lloyds, Ostago, one of their groups there. So I just think people didn't expect that level of cash burn, and because it's so liquid, some people sold on the bell, takes it down. Other people see it's gone down on results who haven't read results properly. And there's copy, the copy trade. Oh, I'm selling as well. It's down, and you get this sort of snowball effect. Well, calm down a second. It's a company just valued, so 12 million cash. It's now 50 million market cap. So three fintechs. One of the Oxygen, for example, is been now EBITDA, well, cash flow positive is getting to now. The second one is EBITDA positive. The two others are likely going to be like that way in the next year's time. But it's just that panic sell in this environment, a liquid stock as well. Man, it just takes it down, doesn't it? Calm down a second. Look at the valuations here. Now, each of those companies are valued at around about 10 million each. It's all fintechs. They're doing very well. They've got, big sort of sign-ups happening and big deals happening coming along. So it's just nuts. I mean, it's just that sentiment selling on the bell, scariness.
Yeah, I did. I spoke. I don't know if you noticed, but I spoke to super smart investor Richard Penny from Crux Asset Management a couple of weeks back or something like that, 2 or 3 weeks back, and he owns Trufin. He loves it. He thinks there's masses of hidden value there, which will come out into. So I'm with you. When you have these situations and you get an unexplained drop, and if you do sort of like balance the books at the end of the quarter and you take a hit in paper terms, think longer term, look at the intrinsic worth, don't get spooked. The key questions always to ask is, has the investment thesis changed? Yeah. If it hasn't, you stick with it. Sometimes it actually goes up, as in with Boohoo, even though the shares go down. And the other one is, if there is a problem, how long is it going to take to fix? And that then brings me on to my next one, where you intro.
I'll say one thing though. I did say to people, I said, listen, people questioned me in my sort of investment club, and I said, now it's dropped like 20% on the bell. Now is not the time to sell. If you want to sell, they're concluding this sort of contract with Lloyds, Ostago, part of the group, at the end, before the end of the year. I said, if you want to sell on a positive liquidity event when it's going to rise. Don't sell now and have a panic knee-jerk reaction, So, so it's lots of things going on there. It's just that, like I said, liquidity and people selling on the bell.
Well, just on that, I mean, I own Lloyds, yeah. I mean, you've had the 10-year gilt yield going up. It's breached now 1%, and so for the banks, for the domestic banks, that's great because it just means they're going to make more money on the margin, on their net interest margin. Lloyds shares today, even though that's happened, even though gilts have gone up, they've gone down by 3%. I mean, you just look at that and you just think it's frankly nuts. But anyway, yeah. So I'm with you. And you look at the results yesterday from Rossyln Data Tech, who, as you know, I own, and I've got battered on it at the moment. But again, you've got to take a longer term view. And I do sort of like couch it. I haven't yet spoken to the management team, so I'd like to. But my view from the actual what I read on the statement yesterday is no different. It's just taking a bit longer to actually reach fruition than originally anticipated. So this whole cycle towards digitization for large corporates, for big data, they also do, which is really great, the sort of clever supply chain data analytics AI for helping large corporates get through this problem in terms of deliveries, in terms of supplier management and product management and procurement and all that kind of stuff. Because I mean, you just look at everybody around the world to get product is really struggling. So they're in the right place. And obviously they've got this customs stuff that is doing quite pretty well through Brexit. But what's happened is that these large corporates, they've been digitizing their front office systems first, the communications, and now doing the accountancy stuff, which is the Sage, and haven't yet really sort of pushed the button. But that's coming in the sort of like the big data supply chain analytics and procurement systems, and that will come in due course. And he's starting to see that. The CEO Paul Watts, who I've only spoken to once, but I think is terrific, and I think the chairman's great as well, James Appleby. They're starting to see that come through. They won a big sort of like 5-year contract with a US pharmaceutical company, and that's a huge endorsement of the actual, the business. But anyway, he's investing. He's doing exactly the same thing as John Little at Boohoo. He's investing for the long term, productizing the actual software, making it more scalable, less tailorized, and he's investing sales and marketing to get the top line growing. So he's doing all the right things. It just is obviously taking a bit longer to happen. And the shares got absolutely mullered yesterday, went down by 20%. But again, I think fundamentally the business is enhancing its positioning in terms of the competition and increasing intrinsic worth. And the shares go down on it was in valuation terms it's not big. And I'd put it one of the advantages of us doing these fund manager interviews is you get a bit of insight into some really intelligent people who own these stocks. And Ken Wotton of Gresham House, he owns it, and he's on about 26 to 29%, something like that, high percentage anyway, of not over 30%. He loves it. He thinks it's going to be doing really well over the next 2 years. It's on a really low valuation. So when it comes to sort of what do I do? You say, okay, coming back to that policy, has the investment thesis changed at Rossyln? Absolutely not. If anything, it's gone up. What's the time scales for it to correct? What's for the locomotive to get back on the track? Well, I mean, it's definitely pushed out to the right. But if you actually read the statement, they reckon to the back end of this financial year, and in effectively it'll be from May next year, it should really start motoring. So another sort of 9 to 12 months before that whole productization, the new software comes on board for their analytics, and they start driving that real top line. So you should see it come through. And I'm happy to sit there and wait because they've got cash.
Half cash, and then they go half.
With
the market cap now, they've got half of that was in cash, isn't it?
Yeah. So so you're right. I've been given a couple of black eyes over the past, and that's healthy actually, because essentially, if you're not careful, if you start, my portfolio overall this year has done really well. I just absolutely cannot complain. In fact, I think it's at all-time highs at the end of the this third quarter. So hey, I've had I didn't have a very good 2020. But if you're not careful, you can get a bit sort of complacent. If things all go right, you can start thinking, actually, you're quite good at this sort of stuff. And you've got to realise my hit rate over 20 years is still only about 62%. Okay. I mean, admittedly, I've made, I go into the sort of the smaller cap area, and I've made return gross, capital in, it's effectively compound average returns of 15% over 21 years. So I really can't complain. But my hit rate is really only, 2 in every 3. So 1 in 3 goes a bit belly up. And that's what you've just got to expect, is such that if you go for high conviction portfolios, you're going to get a lot of idiosyncratic risk and occasionally battered. And I've been battered many times in the past, and I still look back. If I can get through March and April last year, I can probably get through anything.
Yeah. Well, do you know what? I every now and again I could post some tweets and send them out there because just to remind yourself, what you're doing is good, whatever. And I said sometimes that there's 3 positives of a share price dropping on one of your conviction stocks. I said, first of all, you research it more, you triple check your conviction is correct. And then secondly, the under-research holders exit, leaving more high confidence, sticky holders. And thirdly, the company becomes cheaper. The valuation is more attractive. And so the people who are good at researching will pick it up, and they're the people who will hold for longer. So, and do you know what? In fact, saying that, I got to talk about obviously one of my biggest holdings, Escape Hunt, and they came up with half-year results. And of course, you can't really compare it to anything unless you really dig into the figures, because they were shut for what? They were only open for 6 weeks of their H1. 6 weeks, that's all it was. So they came out, they said a massive, strong bounce back, lockdown bounce back. And they said H1 revenue, 1.18. And people thought, that's not a lot. But no, 6 weeks, and 17 sites 6 weeks, that's all it was, May 17th to June 30th. That's about 200 grand a week. Multiply that by 50 weeks pretty much, you get about 10 million. And that's based on 17 sites. They'll do that on 20 sites next year easily. So they got cash. And by the way, those 6 weeks weren't the busiest 6 weeks. There was still some restrictions on, and they've been busier in the last 6 weeks. Like I said, their like-for-like numbers on the sites that are open in 2019, they're now doing 31% more revenue on those sites. So they're getting more profitable and also become EBITDA profitable July and August. So they're heading in the right direction. They've got more cash from R&D as well, extra £1 million in cash, 3.5 million in cash. And they're saying further pipeline the sites sort of discussion right now, including central London. And so now they're valued on EV about 25 million. It's just 2.5 times next year's revenue. So, and it's a very fast growing area, but people just look at that, top line. People don't go beyond the top line and say 1.1 million. That's not a lot. They were shut. You say, what do you expect them to generate? They can't, so you've got to delve a bit and do a bit of research, just break the figures down. And
what did the shares do?
They went up, and I think it brought out a few sellers, for some reason, who didn't like it, and it ducked sort of down a little bit. But they went up from 33 pence up to 37 pence, down back to 33. They're a bit below where they were when they released that. And Richard, the CEO, I spoke to him, he said, I can't believe that. I thought, considering, how long we've been open and there's bounce back with the demand we're getting, it's phenomenal. It's better than
I did. Yeah. I mean, it's a perfect other example, isn't it? Because, I saw another positive of that announcement saying that the corporate side is returning as well. It's really growing. So that is a brilliant, because that's another great example. If you disappoint with the results, you get absolutely taken out by your knees, which was Boohoo. Yeah, Boohoo didn't disappoint much at all. If you hit your numbers, you still go down. If you're in the consumer space like Revolution Beauty and Boohoo, Escape Hunt in the consumer space came out with better than expected numbers and never increased, and actually still gone down.
Yeah, I mean, record trading, cash up, pipeline of new sites coming along, demand is there. But yeah, exactly. I mean, people at the moment, it's almost like I've said when I've interviewed some CEOs, that at the moment, if you put news out, it's almost like you're putting your head above the parapet. It's going to get shot. It's like, be quiet, but you've got to put news out, of course, because it's results. But yeah, anyway, what's next, Paul?
Well, I mean, another one which has actually done quite well, it's gone the other way, which is not in the consumer space, is Northbridge, and they came out with interims. I interviewed the exec chairman, Peter Harris, and he's just since taking the helm only in March, sort of 6 months ago, he's just done a fabulous job. I mean, turnarounds typically take 2 to 3 years, etc. He's almost done it in sort of, he's done a large part of it in 6 months, positioned that business brilliantly for Crestchik. He's executing on the exit from Tasman. He'll get a bit more money, coming in from there. And the shares have done really well. But, I've been banging the table on it. But their Crestchik load bank division is just knocking the ball out of the park. I mean, their sales, like for like, the whole group were up sort of 20, I think it was 22% year on year. But if you actually look at sort of, what the actual Crestchik did, they were up 40%. And they're actually 20% higher than they were in the first half of 2019. So they're really, really motoring. And that's on sort of vibrant, as he described it, data center demand, grid stability, renewables, geographical expansion, marine decarbonisation, and new products like these server emulators they've put in. And he's got so much demand, he's having to increase his capacity of his factory, the Burton-on-Trent facility, by 50%, which should come on stream. So that just looks excellent. It's just a brilliant sort of crown jewel, Crestchik. So I've got, I think that's really good.
When they first came out, I spoke to them, and we talked about them. He looked at them, and looked at the revenue and all that, and thought, that's it. That is undervalued. It is undervalued.
Yeah.
You often question why it's. You think, why is it? Maybe I'm missing something. And people do that, don't they see something too good to be true, and then it's gone, and then they don't invest in it.
Yeah, and also, you look at it. They're actually, like everybody else, they've got a bit of supply chain disruption. They've got higher freight costs. They've got higher commodity costs. But importantly, and this is a sort of like a takeaway for a lot of stocks that people own. Look for companies with pricing power, and they've got it, and they can actually pass that on to customers in due course, and that will happen. So, you look at that. It's a resilient business. It's got a lot of secular growth. It's got a lot of sort of self-help in there as well, and the business. I mean, I've upgraded my valuation from 192p to 200 pence per share. But I still think that's very conservative. And in 12 months, I can see this well above £2. I mean, I've obviously ridden it up so far, and I'm delighted that that's happened. But I've got no intention of selling. I'm just going to hold this one because he's looking really good. And they'll be if they can do that full exit from Tasman by the year end, then they should be basically slight net cash, or certainly net debt free. So that gives them great amount of optionality, because the business is highly cash generative. And whenever the exec chairman says one of his biggest division has had a stonking first half, on the video, things are rolling and rocking pretty well, which is absolutely fabulous.
Yeah. So I try to talk about a couple of stocks I've had on the podcast, actually, which
please
turning around. And one is in the leisure sector. And I did invest in a few years back, but then the pandemic hit, and I sort of pulled up the drawbridge a bit on stocks I held there. But they're called Immotion. They're into VR experiences, and they actually go out and film their own experiences underwater, really with high-class studios. The content is phenomenal. But where their base is in aquariums, for example, so you can go to an aquarium, sit in one of these pods, and or you can have a group experience, and it'll take you underwater, diving with sort of blue backs and all that stuff. It was amazing. But like I said, they've been again shut for most of the year, but they're based in America. They're opening up the zoos now. But you can see the difference here. So H1 revenue just 2.8 million, and the Q3 3 million. So they're doing more in the next quarter than they did. But they're at now EBITDA break even, looking at profit, record results. H2 is supposed to be strongly cash generative. But it's very nice because I know Martin's come on the podcast lots of times, and he puts a lot of effort into the content that they create. But now they're going to zoos, lots of demand there. And he said the zoos are a lot bigger market than that. But I definitely want to get along to one of their sites. And in fact, VR, it's funny, isn't it? A long time back, VR was the hot thing, but people didn't know where it fitted, Now you're starting to see businesses fitted in. And in fact, what I quite like is Richard from the Escapement was coming on and saying, our physical sites, for example, will have 4 or 5 physical rooms, and you can't change the stuff out of that, of course, for a while. They're modular. You can after say a year or something, but it costs money. Now we have VR rooms, which we can have, say, 4 experiences in the VR room, but a flick of the switch, we can change the content. So that's amazing. So now they've got Alice in Wonderland. They could do seasonal stuff like Christmas or Halloween stuff, but they're going a bit bigger on the VR thing, because you can have one site and you can have, say, 10 different experiences in that site. So VR is being used now for a long time. A lot of people tried it and they couldn't get on with it, but it's starting to be used, and Immotion are doing it very well, and I think Escapement are doing it very well.
Yeah, and I think something to draw out from both of those companies is such that the financials, because of what we've just been through, don't reflect the underlying or the true value of the actual business. So another one which came out with half-year results is Avacta, which is exactly in the same position, because they've only got modest revenues at the moment, but actually the amount of progress that the group has made, it's headed up by CEO Alistair Smith, particularly in the sort of therapeutics, has just been phenomenal over the last 6 months. I mean, they've obviously got the doxorubicin targeted chemo warhead treatment that they have, which has entered clinical trials and doing the first dosing in August, and they're hoping to get a good readout on that by December, which could be a huge positive catalyst for the shares, because the market there is massive. And they also got news earlier in the week that they'd one of their royalty partners, LG Chem, which is not using the chemo side, the Prodoxorubicin, is in their precision platform, and the Affimer platform is used for is used by LG Chem, and they are basically got some very good preclinical data for one of their actual immunotherapies, checkpoint inhibitor treatment. And that has sort of triggered an actual milestone payment, and that could go into clinical trials as well. But if you actually look at the underlying technology of those two platforms, it is potentially transformation in huge billion-dollar per year markets. And if any one of those new treatments, and they've got, I mean, Avacta's got so many shots on goal. If any one of those comes through, the shares will do absolutely brilliantly, because it will not only give them that revenue for that particular compound, but it will also then underpin the applicability of either of those platforms going forward for more drugs in development. So you've got a much bigger picture there. So the therapeutic side has gone great. And what's happened with the shares is that obviously, what the UK government, having sort of, endorsed and supported a lot of UK lateral flow testing companies, has just basically decided we're not giving them contracts, or hasn't done at the moment, and therefore the volume that the whole industry was hoping was going to come through for the UK industry hasn't actually yet transpired. And Avacta aren't waiting around. They're now concentrating on the corporate and the business sector, and also in overseas. And it is a huge market, there's no doubt about it, and over in Asia, and are seeking
Is that volume going to come through though? Because I know there's a couple other stocks in the market, just that's what they do, and they've been, I see, loyal shareholders have been waiting for the government to announce these contracts. Is that going to come through or not? Or what's the deal with that? I mean,
have you spoken to the Secretary of Health? Well, nor have I. So I can't. I've not got any answer. I don't think anybody.
I see. I see people on Twitter a lot, and there's another company, of course, not Avacta, but they're always on the sites of the Department of Health sites. Look at these contracts being awarded and say it's coming, but it's been touted for a long time. I think Avacta has sort of suffered a bit with this success a little bit, but the share price has risen very quickly. Yeah. When you ever get that, you always get people sort of trading it, and then you start getting a little bit of selling it, and it snowballs a little bit. But sometimes that spike up is an insight into the future potential, But then it's nice to have a steady rise. I know some shareholders like a fast rise, but steady rise is always better, because you don't get people selling or dumping lots of stock, And so it's got a technical problem where whenever there's a rise now, people tend to sell it quickly because they're scared it'll come back down again, So it's got to churn out those traders, really, hasn't it?
Yeah, but I would say underlying the fundamental value, the intrinsic worth of that business, it's actually gone up significantly, even though the shares have gone down. And the good thing that investors shouldn't lose sight of is they're fully cashed up. They've got 37 million pounds of net cash at the end of June. So they've got enough funds by a mile to give themselves to fully commercialize their whole therapeutics and lateral flow strategy. So there's no reason to get worried. Just give them a chance to actually deliver against it. And as I say, they've got just multiple shots on goal, and any one of those comes through, and you'll just see that whole business being transformed. So you just got to be patient and don't get spooked by it. Another one in the healthcare area that's been hit by the diagnostic side, the COVID testing, is Sourcebio. And I interviewed Jay LeCue, the exec chairman there, and they were one of their infectious diseases business has obviously been hit because of the PCR testing. The government has changed the rules in terms of people returning to the UK on day 2 and day 8 testing. Which will knock going forward revenue, but it's still they're expecting revenues for this year to be up 70%, and they'll have they've already got 20 million of cash in the bank. And when you look at the base business, that is now perfectly placed to help the NHS reduce the patient waiting lists, particularly on the pathology side with the screening for cancers. And on the genomic side as well, because that's going gangbuster. And then you've got this stability storage, where they're a world leader, and there's more drugs entering, the pipeline going forward for drug discovery. So they are extremely well positioned. And when you look at the shares, I think they're trading at about 140 now. I mean, I can't see how these things, just on the base bit, without the cash, without any of the PCR testing, I can't see how anybody, the shares are worth less than £1.50. And therefore you've got huge underpinning, and you get all of the you get the cash, you get the lateral, you get all the PCR testing for free. And it was quite interesting as well. Christopher Mills over the last couple of weeks has said he's scratching his head on the valuation. It's absolutely nuts, and there's significant hidden value in that business. And I think Jay is right. You just got to give these things time, because the business is really well positioned. It's in a high value, high demand area. It's got a lot of sort of like, technology. It's got a lot of barriers to entry, and the shares are cheap. So,
Yeah, is it just a case of it, sentiment-wise, is bunched in with just people don't see the other parts of business. They just say, it's a COVID testing stock, and they don't realise, no, it's not just a COVID testing stock. Look beyond that. Maybe it's just that sentiment.
And then another couple of sort of health guys, because I know you spoke to Monique Fayad, didn't you, the CEO of Trellus, with her interims, and I was
going to say she's amazing.
She's amazing. Right.
I had about sort of 5-6 questions to ask, and she covered all of them without me asking them. So it's like, I thought, wow. So but and I said, and I even after the first question, I feel like I don't have to ask anything else. But completely, head over it, really passionate about it, knows where they're going, and obviously, a massive market in the US. But I like her a lot. She's very good.
Yeah, I mean, they've got a unique technology, haven't they? Inflammatory bowel disease, looking at Crohn's and colitis, a resilience management telemedicine platform that also dovetails with all the scientific patented knowledge which has come out of Mount Sinai. So it's got huge competitive advantages that could frankly revolutionize the treatment of chronic diseases, not just in inflammatory bowel, but around the world. And given I've got one, I know exactly how important this is. So, and they came out with, I think again, the shares have dipped of late, and they've come out, they're knocking the ball out of the park. They're doing exactly what they said at the IPO back in May, and they're getting hit by it. They're getting hit because just a sort of sentiment. So, another one to, for people to have a look at. And just to give you an indication, last time I looked, I think the shares were sort of like 60p, but if they
60 pence, yeah.
So if you look at it and you just say, right, they're going to get 1% of the US market, then based on the recurring revenue streams from that, a 15 times say EBITDA multiple, you get a share price of £1.90, and you just look at it and the upside is huge, and they're doing exactly what they said they would do. They're fully cashed up as well. So, hey, just is one. It comes to these things become as much as, which cherry do you want to pick? Because there's so many of them out there that has just looked mispriced in terms of, sort of like where the shares are versus the intrinsic worth of the actual business. I mean, another
it's almost time. It's almost like having the timing right, isn't it, on these stocks? Because I doing a webinar on the Sharepickers Investment Club, I was saying there's plenty of sort of med tech stocks based in the US. They're very good at the moment, and you just basically have to do some research and find. You may not want to go for all of them, because it's about 5 I can think of. But and I did say, give a challenge, and I want you all to look at them all and see which you think. It's obviously subjective, but which you think has the biggest potential, which you like the most. And sometimes it just comes down to personal favorites and what the story, what rings with you, and why you like it in some way. But there's plenty to pick from. Like I said, but it's just having the cash at the moment. And we've had I was looking at my Q3 results, and Q1 was excellent for me. Q2 was okay. Q3 was a dog, and now it's like that hit sentiment, isn't it? You think, oh, is it going to be Q4? What's going to be like? It started off quite badly, but October is not very good months. But I think we'll have after October's out the way, I think we'll have a decent rally. We need a bit of consolidation.
Well, hey, I mean, we're just on that healthcare theme and on sort of like major positive triggers. 5th of October, what does that remind you of?
I know, yes. Yeah. It's funny. Do you know what? We talk about that, the play of sentiment. It's like, I said it in this chat group. And Polarean, the NDA, new drug application for the FDA approval should be on the 5th. But even yesterday, I talked to Vadim, which is a health guy from SP Angel. And he said, of course, it won't be on the 5th. I said, I know what you're going to say. He said, yeah. There probably won't be any delay, but you understand it's the 5th in the US. So it'll be afternoon time here. By the time they get the news, It'll probably be the next day or collate it and send it out. And then people started sort of panicking on that. It could be a delay. People see some trades, big trades going through. Like yesterday, I looked at this. Like I said, it's a 200 million market cap, but the top, I think, was like 16 trades or above 20,000. So, and so it wasn't the piddly, £100, £200 private investor money there. So some decent volume going through on a small cap stock. And yet one was a decent sort of sell. And then people said, oh, someone knows something. No one knows anything. Even the CEO doesn't know. Calm down and think of the business, not the share price. Because the share price went down a little bit on that big sort of trade. I said, try and think of the business, not the share price. That's all you have to do. And that's it, isn't it? Sometimes you have to disconnect to the share price and the business. As long as the business is going the right direction, the share price should catch up, and that's all you can do.
Yeah, I would say, I'd add a bit on that. It's the business and what the intrinsic worth of the group is, the actual shares. So you have to look at both of those to compare it then to the share price. I mean, another one, which again, the shares have come down on good news, was Oncimmune, because they signed a really great second deal with a very large pharmaceuticals for one of their immunoinsights sort of like development projects, and the shares have sort of come off, and they're a world leader in this whole sort of like autoimmune profiling and biomarking space, and they've got breakthrough technology, and they're perfectly positioned. So we just say, you put out good news, you put out bad news, and your shares are going down. So it just depends on how much.
I just want to mention this one because there's a lot of sentiment, gas prices and all that. And I had a guy called Bobby Kallar on, he's CEO of U-Energy. And people started, and the share price just started going down. And he came on the podcast, said, we're not affected by this. And U-Energy, just to point out, they're an independent supplier of gas, electricity and water, focused on serving the corporate sector throughout the UK. It has no involvement in the domestic market. And he came on pre-results saying, well, you see by the results, it's going well, and the forward guidance is still going very good. And so their revenue growth of 43% to 65.8 million, profit for the period, just under $1 million there. But gross margins improved. Average monthly bookings increased by 55% to 9.6 million. Cash they got just under 12 million, debt free. And he said, and listen, we're confident we'll do better than that in the second half. But it's the trouble at the moment, sentiment around everything energy related, it's not good. So, but it was worth looking at because of the market cap on that. Let me have a look at it. It's, like I said, that kind of revenue. And they're sub 40 million market cap, and they're going to do over 100 million.
That's right in your space, then, isn't it? It's sort of like small sort of stuff that can, would you say, inverted commas, 10 bagger.
Yeah. No, so it's just and the thing is, so when we have this negative sentiment, things get batched together, and some get sold off with others. That's opportunity. If you can find the ones that are not like the others that are getting smashed, but are being loaded in with that lot, then that's opportunity, isn't it?
Yeah, I mean, the other one is Totally, isn't it? I mean, they signed, I think, was it 16 million pounds of additional contracts or contract extensions with their urgent care for the NHS, which is the 111 service, essentially, and their other division, which is basically helping the NHS get through the huge patient backlog. So they are perfectly positioned, and they have just fabulous relationships with the whole NHS. They're part and parcel of that whole healthcare in the UK delivery platform. So they, and the CEO there, I've interviewed her just once about 3 or 4 months ago. She's terrific.
Yeah, Wendy,
doing a great job. Love it, yeah. And the shares have gone down. So you sign a really big contract or contract extension, and you still get mullered. I mean, it just is bonkers, isn't it? So
I think I talked to Wendy before. She's saying that people thought we did really well because of COVID, and she said, "Have you seen the waiting list?" It's like, we're not going. I said, "You're not going to get any less busy, Wendy." She said, "No, if anything, it's going to get more busy."
Yeah,
and because a record waiting list over 5 million people, and that's our bread and butter there. So it's not going to get any less busy. So
two other stocks that I own that is worth just very, very quickly going through. Equals, now their biggest shareholder is Crystal Amber, who came out with their prelims. And I'll just read you. Hang on, where was it? Oh, I can't remember what it was. They put a commentary. Here it is, yeah. This is what they say in there. So if anybody can see it, it's public, yeah. It was in as an RNS. This is talking about the industry. With larger players keen to acquire fintech capabilities, the fund, i.e. Crystal Amber, believes Equals is an attractive takeover candidate. They
Wow.
own Crystal Amber 22%. Is that saying something or what? So, and the shares, and the reason why I mentioned it, because the shares have gone down today by 2%. I mean, it's just absolutely crazy. And another one, you've had, Eleco, who I own, this sort of like build tech software expert. The shares are roughly around about 120. You had the exec chair lady, Serena Lang, buying £100,000 worth of shares. And you also had the CEO, Jonathan Hunter, adding to his position at about 126, 127, saying to me they see a huge runway ahead and opportunity. And again, the shares have come down. I mean, you can't really run away from this. It's just like, this is a time of the year where people are just looking to sell, get a bit of sort of like, cash on the balance sheet to be able to deploy. And you can understand that sort of like that strategy. But where you sell businesses that are just so, got so much potential upside and growth, it just looks like a daft decision to me. And I would love to have more cash. I'd love to have some cash, in fact, never more. But frankly, there's any ones in my portfolio that I'd be sort of, burning to sell to raise money.
Yeah. In fact, and I'm going to mention one more because it's one I hold, because a broker note came out, and it's from Gfinity, of course, esports and the platform, the tech as a software. But the broker note came out upgraded. They've done 2 acquisitions, they're very good, and they've upgraded the growth here. So, and this is the first year, actually, the finals out in October. This is the first year John, the new CEO, has taken over with new business model, big margins. The last management was burning cash like crazy, and this year, they're going to be. So look at this. They're going to have 21% growth this year. First time ever it's turned around this business model. But next year, it's like 72% growth top line. And then the year after, 58%, 42%. They've got a target price of 9.5 pence. The share price at the moment is 4 pence, because they are putting in place now. They've got lots of different, websites with good advertising opportunity, very targeted in esports and niche sites and gaming, all this stuff. But yeah, they're doing well. And fair play, John came in and I spoke to him twice on the podcast, and he did say we're going to cash flow break even next year. And I didn't believe him at the time, because I was used to Gfinity's own management, just burning cash like crazy. And it took about 2 or 3 interviews with me before I said, I like this, what he's doing here, because he's actually doing it. And it's now going to be sort of profitable to 2023, hopefully yearly profitable there. And the growth is amazing. And all the perceived growth is amazing, or forecasted growth. So yeah, I like it. But again, it's had warrants. They nearly went on the edge of going through in the last management. And they had to do a very sort of bad placing that kept the sort of company alive. They had to do warrants and all that stuff. So you've had this warrants overhang, selling into the stock all the time. And now they're becoming expiring this month in October. And also they've got final results at the end of this month, which is the first year of positive top line growth and margin growth. So I think we're going to get at last some positive news from analysts on this, because it's final results. And generally some analysts just generally look at final results. But yeah, it's good. I like it. Hot space. And I like to see a CEO come in with a plan and actually stick to it. And he's doing it,
Yeah, we've got plenty of those. And the other thing, it's sort of big picture questions when, companies, knock the ball out of the park and do really well. And then it gives the investor, what do you do running your winners? And I come back to sort of like, does the management team consistently outperform? Is the industry attractive? And is there simply just plenty of upside? And two stocks, again, we've had a lot of news this week, and I've done videos with, is firstly Avingtrans, and I spoke to Steve McQuillan's CEO and to Stephen King's CFO a couple of days ago, and they've just done an incredibly good job. EBITDA was up 78% year on year on revenues. I can't remember how much it was, and so they beat consensus. There's a positive outlook. Avingtrans are a specialist niche engineer that are in sort of like things like nuclear and in sort of solar, etc. And they do those low-level nuclear waste storage boxes, which is designed to be able to store medium waste medium radioactive waste for 500 years. They do blast-proof doors for HS2 and for other things like submarines and stuff like that. So they've got lots of really long-term growth drivers. And if you look at if you ask the question, do this management team consistently sort of outperform? Well, their shares have gone up by 23% compound average over the last 10 years. And it just shows you. And The shares did happen effectively over the week, even though they came out with good results. They're fully cashed up. They're ready to deploy another 20 million or so of cash because that's what they have on the balance sheet. But looking very selectively for opportunities, and that's their core business. And also what they've got is a really exciting. It's a helium-free small form MRI scanner that they're hoping to develop, and they've got enough technology, enough money to develop that easily. But this could double the share price, according to Christopher Mills, just on its own because of the $400 million, £4 million high value market that they're addressing that is really totally untapped in things like sort of like orthopedics and in neonatal and also veterinarian. So there's a huge sort of runway ahead for that. So the management team has done a great job. They'll continue to do a great job. The industry that they're in are attractive, and I still think there's plenty of upside. I mean, I cannot see how the shares aren't worth. I mean, I've got a fair value on some of the parts of now increased it from 507p to 526p. Shares are currently 450p. But as you say, if they hit the ball in terms of the MRI scanner, these could be 8, 9, 10 quid in a couple of years' time. So again, when it comes back to the question, holding your winners, I mean, I don't think there's any reason to sell this one. And, everything seems to be aligning, the stars are aligning. And another one which came out with another winner is one which recently IPO'd, Saietta. And I know we talked about this. And
that's done very well. Share price has gone. Do you know when you speak to a stock and it's in a hot area and you think you could... I could jump in here for a trade and not even have to research it. I know it's going to do well. And it's done so well, the share price, doesn't it?
Well, that's your space, and you're the expert on all things.
No, I did the same with the Eleco. They were in that hot space of solid state batteries, and I just knew I don't know how much competition will have down the road there, or whether it'll be the leading player in the battery market. But just because it's in that space, and at the time it wasn't that overvalued, I knew it was going to go mad because not many people knew about it. And whenever it was going to be a bit of it.
They IPO'd in July at 120p. Yeah. They raised £37.5 million. I think the shares currently are roughly around about 240. But the runway of this one is still huge. I mean, just give you a bit of background for investors. I mean, they do revolutionary axial flux electric motors for electric vehicles, and but they're focusing largely on the sort of the 2 and 3 wheeler out in places like India and China, but also motors as well for marine outboard motors. They're doing now high performance cars as well, and they've just signed a contract with an Oxford-based company called Electric Assisted Vehicles to do a sort of like a inner city EV to replace the sort of standard transit van, which again could be a huge sort of market. Any one of these is just enormous opportunities for them. So when you look at sort of like running your winners on this one, well, if they got a sort of only 5% share of just this sort of 2 or 3 wheeler market, then I reckon they'll do $90 million of EBITDA, which would equate to a share price of £10 compared to 240. And you look at it, okay, 240, that's doubled in 3 months. Well, that's a pretty good return. But there's still the runway ahead of this one's great. And I would encourage, if anybody's interested, have a look at that video that I interviewed. It's an operational update that the company put out with CEO Vic Kist. I mean, he's terrific. He really is. Again, he's good. Passionate leader, knows what he's doing. He's done it before, actually. I mean, he just loves that whole industry. And what's also good in Oxford there for electric vehicles, it's a real cluster of expertise, and they've got patented technology. I mean, there's no doubt about it. I could see this being a billion pound market cap in about sort of 4 or 5 years, and they're only on 200 million. So there's lots.
Yeah, is that? I mean, he's saying that when they were starting up the idea and started running engineering models and all that stuff, that he realized there was nothing out there like this, or and is that the case? Is it generally quite unique in this space?
There's no. I mean, there was research that I've done. I cannot find anyone who's actually created one of these axial. There aren't many manufacturers of axial flux motors, put it this way, electric motors. One of them has just been bought for its strategic importance by Mercedes, which just called Yasa, which just shows you how important it is. Another one has just IPO'd out in NASDAQ that's got inferior technology, and looks at EVs, but not the 2 or 3 wheeler market, and that's called RE Technology. That's REE Tech, and they're valued. Last time I looked, over $1 billion, and they haven't got any revenues. So they're pre-commercialization. So it just shows you the scale of and the value hidden within this particular business. So I mean, if you look at sort of like, and they're the only ones I really know who have got comparative technology, but they're best in class in axial flux electric motors, which is great. But they're the only one who's created, designed it, so they've now got a cost competitive advantage to be able to do them in 2 and 3 wheeler. Sort of like motorbikes, tuk-tuks. Nobody else can get the cost down.
The Far East, a huge market, isn't the Far East as well for that area? Because everyone, you see these big cities in the Far East, everyone's on motorbikes or on mopeds and all that stuff. Everyone.
Yeah, but we've got some other big medical. I mean, they just quickly on AstraZeneca, one of the companies that I sort of own. They came out with a big sort of like phase 3 trial success for new breast cancer treatment, and likewise with pancreatic cancer as well. So that's going great guns. Merck is going to be a massive data point for the market, which I think on its own could be as important as the vaccines last year, or almost in one, because they've got phase 3 trial results for their blockbuster COVID antiviral therapeutic in tablet form, which means that people can actually take it. If you've got a compromised immune system, which will mean the Western world, particularly the Northern Hemisphere, will get through the whole winter for 2022 without any major problem to any of the healthcare systems, as long as they can produce it. But that's a tablet form, potential blockbuster antiviral, and that could come. Those results, given what I've heard from the CEO there, could come out within weeks. And if that happens, you'll see. Remember that last year in November when we got the series of vaccine news? It just took the market up and up and up. And I think that's the biggest chance of changing, sentiment totally.
Mm-hmm. Yeah. Do you know what I think though now? I mean, we're totally sort of unprepared for this pandemic, wouldn't we? But now there's so many, like drugs, antivirals, new technology being discovered. So should another one come along, of course it'll hit the markets. But I think when you think about it, normal vaccines 10 years, and we did it now this time in 10 months. And they've learned so much. I hope the funding does go into future prevention. I think it will, of further pandemics, because it's been a nightmare. I remember talking about this, the COVID thing, when it first came out, and we won't be talking about this in 6 months' time. We're talking about it in 18 months' time. It's like still here. The tail on this thing is phenomenal. But what's quite nice that it's not the front of the 6 o'clock news all the time. It comes in after about 15 minutes. Which is like gas prices and energy and supply chains because of it. Exactly. And the UK has done a great job. And as an economy. And the gilt yields over 1% are showing that the economic rebound is occurring. So sentiment towards consumer-related stocks in the UK and internationally just looks totally misplaced to me. But we'll wait. Well, I'm bullish. Otherwise, I wouldn't be an investor, Paul. You've got to be bullish. What's the point of investing? I know. But, excellent stuff. Anything else? No, I think we've definitely covered a lot of material. So save the rest until into 2 weeks' time and have a good weekend. Yeah, listen. By the time we'll be on next time, we'll know whether Polarean get that FDA approval. Wow, that's a big deal. Hey, if it's big news, mate, we should do something just for that because I think it's such an important milestone. So exactly, well, it's a huge. Just one thing, but if you go back to the basics of when you're going for something like this, you look at safety and efficacy. Is it safe? First of all, efficacy. Does it work? Yes, a lot better than anything else out there. Is it safe? Well, they're using xenon gas. That's not even radioactive. There are contrasting agents now passed by the FDA that are radioactive, and xenon gas has been passed by the FDA previously. So even though it gets us nervous towards the thing, just look at this safety and efficacy and thinking it can do a lot better than what's out there, and it's quite safe. So all the experts I say there's a 90% chance of getting rubber stamped. So I'd be absolutely stunned if there's any. The only thing I would say that potentially could be different is that effectively the treatment area is narrower than what people think. You can't use it for every MRI scan, but hey, let's just wait and see. Yeah. Okay. Well, even 1% of the American market means it's huge. For the global market. Cheers, Paul. Thanks for that. And if you listen to
Take
the podcast, don't forget this is on video. And if you go to the YouTube channel there, hit that subscribe button, notification bell, and you get notified by email next time we're live or going live.
And
Thanks,
if you
Paul.
want to follow any of the stocks that we talked about, go on the website, just click the button, and you'll get everything straight into your email. Even just in a nice smart shirt, crisply ironed.
I've made an effort this week. Yeah, exactly.
Good man.
Next time we're on, if Polarean if it gets passed, I'll wear a DJ.
Yeah,
everything.
Wear a tie. Take care, Justin. Thanks.